Hello, everybody, and welcome to Chapter 6. Today, we are going to be talking about inventories and cost of sales. I'll do an introduction on how we account for inventory. We talked about it at great length in Chapter 5, so now we're going to be looking at different cost flow methods, not the same as how our inventory physically flows in and out of our business, but how we assign cost to inventory. We're going to be talking about what happens when inventory is in transit. Who does it belong to when it's being shipped from point A to point B? And then I'll assign some homework, and then there's another video that will do a follow-up to the introductory comments today. So let's go ahead and take a look at the PowerPoints for this unit, which, as I said, inventories and cost of sales. So what we need to start out with talking about is what actually belongs in inventory on our books. So it's anything that's in transit, depending upon what the terms are. Obviously, it's everything that's in my warehouse. That's critical. It's any goods that I still own that might be on consignment. And then we need to also account for goods that are damaged or obsolete or just really don't have any value to my organization anymore. So first thing we really need to pay attention to is goods in transit. When you sell something, a tangible product, let's just say that I'm in textiles and I'm selling bolts of cloth from Algeria. And there is a textile salesperson in Algeria, and then I am purchasing in New York City for my office furniture business. I'm purchasing textiles to cover my office furniture. So I make a transaction. I engage in a transaction with the vendor in Algeria. We're going to negotiate price. We're going to negotiate how the textiles are shipped. We're going to negotiate a number of things. And one of those is who pays for the transportation costs. There's two ways that things can be shipped, inventory can be shipped. One is FOB, shipping point. That means free on board shipping point. And this is when the buyer takes, or when the shipper, the vendor takes the product down to the loading dock and puts it on, it's free. In other words, the shipper is not paying for it. It's free to him or her. The buyer is paying for it. So the minute that those products are turned over at the shipping point, the buyer's paying the freight. Therefore, it's included in the buyer's inventory. It's not in my warehouse right now because it's in transit across the sea from Algeria, but it's still going to be included in my inventory. Free onboard shipping point. The buyer pays the freight. FOB, destination, is exactly the opposite. Free onboard destination means wherever it's going, the person is going to pick it up and not owe any money. Therefore, the shipper has paid it. So since the seller is paying the freight, the seller owns the textiles while it's in transit across the ocean. So before you know whether to include something in your inventory or not, when it's in transit, you need to know what the terms are. And the way I remember it is just, it's whoever, it's the opposite of whatever it says, is the person that paid for the freight. So free onboard shipping point, the buyer paid, it's in the buyer's inventory. Free onboard destination, it was paid by the seller, it's in the seller's inventory. Goods on consignment, you know what that is. It's if I take my RV or my clothes or my electronics and it's sitting in somebody else's shop, I own this as long as the consignor, and the consignee is never going to own it because they're just the broker. So it stays in the consignor's inventory. For products that are damaged or old or degraded in some way, we have to actually record a loss and mark that inventory down to something called net realizable value. What is it actually going to be sold at, if anything? So say I'm carrying a bunch of iPhone 5s in my inventory that I purchased for $600 each to resale. Well, now really they're not worth probably 40 bucks a pop. So I have got to write them down to net realizable value. So inventory, what is inventory actually carried at? Well, obviously it's the price of what you paid for the inventory, but it's a whole bunch of other things too. And as we learned in chapter 5, so you've got to take the cost of the invoice cost, right, what the inventory costs you, any purchase discounts, purchase returns and allowances, right? So it was damaged, but I don't have to send it back. Or I paid within the 10 days, so I got a discount on the invoice, right? But then there's a series of other costs that go into it. Well, like what? Well, we just saw shipping costs, storage when it possibly gets on site and I'm not able to move it quite yet. It needs to be stored. Insurance, import duties, anything like that also gets captured in the asset account of inventory. Let me just shut the door. Hold on a moment. Sorry. So we're talking today about, so I've got all these costs captured in my inventory account, and then I start selling inventory, right? So, and let's say that I have something that's like a like kind product, just like bolts and bolts and bolts of textiles, right? No differentiation in pattern or thickness or weight or any differentiating features. It's just tens of thousands of bolts of textiles, right? So how am I, and I'm purchasing them at different costs, right? Like right now we know with everything that's happening, oil costs are up, so therefore shipping costs are up, so therefore the cost of one bolt of fabric is much higher than it was even say 2 months ago, and certainly more than it was a year ago. So if I'm turning around and selling some of these bolts of fabric, how do I account for the cost flow for these bolts? Now, sorry, I'm kind of jumping ahead here. One more thing to finish off. So we account for our inventory coming in and out of our warehouse through our books using some different cost flow assumptions, which we're going to learn about. So is that enough? Can I always just trust that whatever I have on my books is what's actually in my warehouse? And no, usually a company will take a physical account at least once a year. So you will go into your warehouses and think about how complex this is if you're a major multinational company like a Walmart with, that carries 50,000 different products and has, physical sites in 100 countries. You have to do a cutoff period, December 31st, and take some sort of a physical account and then adjust your inventory accordingly. And you're always going to have, spoilage and theft and obsolescence and all sorts of things. So it's important from an internal control standpoint to go in once a year and say, hey, what do I really physically have? So these are the costing methods that I was talking about. There's 4 that are widely used. Specific identification really is only used with really high cost, easily identifiable things. Like I say that I have my inventory is diamonds or special gems or high-end cars or very specific electronics or clothing. So it's very, I bought these 4 stones from a mine in Zimbabwe, and now I'm turning around and selling them. Of course, I'm going to specifically identify which diamond is sold, and I'm going to know the cost associated with that, right? So specific identification is used for really high end but low number of sales. The other 3 methods are used for high volume where I'm not specifically saying, this bolt of textile I bought for $1.69 and then I sold it for $3. I'm not going to know that because there's millions of bolts of cloth. So I'm going to use probably one of these 3 inventory costing methods. So I'm going to define them and then we're going to look at some numbers. FIFO, first in, first out, refers to a cost flow assumption. And again, this may or may not be how the products physically flow, but a cost flow assumption that the first thing I brought into my warehouse was the first thing I sold. And that actually makes sense for things like, foodstuffs, right? Obviously, the first lettuce that you bring into your warehouse is the first that you're going to sell, okay? So in a period of inflation, the first products that I bring into my warehouse are the first I sell. So they're going to be the lower cost stuff. Those products that I sell, as you know from last chapter, come out of my inventory account and go into cost of goods sold. So my cost of goods sold under FIFO is going to be low. The amount on my balance sheet for ending inventory is going to be high because the old stuff went to COGS. The new stuff is still on my balance sheet. Last in, first out is just opposite. And that assumes the last bit of product that I brought into my warehouse was the first that I sold. So that doesn't really approximate a physical flow, does it? Very few companies are going to be selling their newest stuff before they sell their oldest stuff, right? But LIFO is used by a lot of companies because in a period of inflation, LIFO assumes that the newest stuff was sold first, therefore the highest price stuff was sold first, and so your cost of goods sold is higher, which makes your net income lower, and it makes your taxable income lower. And then weighted average requires calculating after each purchase a new average cost basis for all the units you've brought in. So that you need a pretty sophisticated set of calculations to do. So let's look at these. Again, FIFO, LIFO, and weighted average. What we're doing is taking our product that we purchased, and it looks here like I bought some product on May 1st for $45, and then on May 3rd, some more for $65, and then on May 6th, some for $70. Okay, and the 3 purchases here and here. The difference is between these 3 methods is what amount goes to COGS on my income statement, okay, and what amount is left in inventory on my balance sheet. And again, in a period of inflation, cost of goods sold is always going to be lowest under FIFO because first in, first out, that's my oldest product is being sold. So that's going to give me a low cost of goods sold and a high gross profit, okay, which looks good on my books, but also translates to higher taxable income. My balance sheet is, of course, going to have a higher number because FIFO, my newest stuff, is on the balance sheet. With LIFO, my oldest stuff is on the balance sheet because last in, first out, I sold the last stuff in first. So my cost of goods sold's high, my gross profit's low, and my old stuff is on the balance sheet. So in a period of inflation, that's a lower number. And weighted average is always going to be right in between. The inventory number is going to be in between LIFO and FIFO, and the COGS number is going to be in between. And you can see here, if these are each just 1 unit of purchase, that we're going to use a weighted average of $60 per unit sold. So again, you should remember this model from chapter 5, beginning inventory, what was in my warehouse at the beginning of the month, plus everything I purchased, is going to give me something called merchandise available for sale or goods available for sale. Then I'm either going to sell it, COGS, or I'm going to still have it, ending inventory. So this cost flow is super critical because every transaction impacts your profit and loss statement, your P&L, as a COGS. It also impacts your balance sheet because of inventory. So choosing a cost flow method that makes sense for your company and applying it correctly, super important for your financial statements. Okay, so again, that's what I just said, that it affects both inventory and COGS. And of course, as we just learned, your physical flow is not the same as your cost flow assumption. If you are a seafood salesperson, you can still use LIFO for a cost flow, assuming that the newest seafood is what you sold first. Well, obviously, that's not how you did it because all your old stuff would just, decompose. So it's a cost flow assumption. All right, so this, let me just make sure, is what's in your book on page 216. So what this is it's just showing a month of activity for a company, and this is just one type of mountain bike. Obviously, you can't mix, different women's and men's and high end and, different kinds of mountain bikes. So this is just one particular type. So this is how you set up a chart. So you should get used to doing this. There's 5 columns: the date, what's going on, the activity, some room to do your cost analysis here. I started with 10 units at 91 bucks each, so that means $910. And then you need a column for what you sold. And obviously from last chapter, you remember obviously what you buy your units for and what you sell them for are very different numbers, right? And then the final column is a running tally of your inventory. So let's just go through this. I started with 10 units at $91. So 910 bucks, number of units, 10. Then I bought another 15, and you can see, look at that, I'm already paying another 15 bucks a bike. So period of inflation, right? So another $1,590, and now I've got 25 units. Okay, then obviously I make a sale. And you can see I sold 20 units. So now I'm down to 5, right, in inventory. Then I buy another 20 units, again, in period of inflation. So I'm up to 25 units, purchase another 10, period of inflation. You see where I'm going here. And then on the 30th, I sell another 23 units. So essentially what's happened during the month is I started with 10 units and I purchased another 45. So total units available for sale were 55, right here. What was the amount available for sale? Beginning inventory of 910 plus purchases, net purchases, 5,590. Our task based on the 3 methods is to assign cost to the 43 units I sold and the 12 units I have left sitting in on my balance sheet in inventory. So this is going to become my COGS number on my P&L. This is my balance sheet number. If I'm using FIFO, first in, first out, my cost of goods sold number is going to be what? Higher or lower? So just think about that for a second. FIFO, first in, first out. What's that going to do to COGS compared to the other methods? And the answer is my cost of goods sold is going to be lower because first in, first out assumes that I'm selling these lower cost items. Okay, so my COGS is going to be lower, gross profit's going to be higher. If my COGS is lower, my ending inventory, these 12 units, is going to be high. Okay, specific identification is identifying which specifically of these bikes were sold. This is not probably a method that you would employ when you're selling bikes for 100, whatever, what was the sales price? For 130 or 150 bucks a pop. You're going to use specific identification generally when you've got more high-end products. So I'd like to go and illustrate FIFO, LIFO, and weighted average. So FIFO, oldest stuff becomes COGS, newest stuff is on my balance sheet. So let's look at this. This is the same data set that we were looking at on the bottom of page 216. And now you can see this slide is what's in your book on page 217. And this is what you are going to need to produce. So 4 columns, date, goods purchased, COGS, and inventory balance. Okay, so here I start with my 10, then I add 15 more units that I bought. So I just take the 10 at 91 bucks, add the 15 at 106. I've got $2,500 sitting in inventory until I make my sale. And on the 14th, I sell 20 of those units. First in, first out. So I start at the top of the chart and move down. I pick up 10 units, which are my very oldest stuff, right? First in, first out. And then I pick up another 10 units from the next batch. So what I'm left at, first in, first out, I've sold $1,970 worth the COGS. And actually on the slide, sad, this is wrong. In the book, it's correct. That should say there should be 5 units left at $106. So I'm gonna just pop over here and show you what this should look at. Sorry that these slides are wrong. Okay, so let's replicate. In fact, let's do this together just so that we can kind of get a feel for this. So let's make our column headings together. So get out a piece of paper and turn it sideways. Let me just put a couple columns up here and let's see if it'll. So we've got date, goods purchased, COGS, and inventory balance. Okay, so make your 5 column headings. Let's focus. Okay. So on 8-1, my beginning balance was 10 units at 91 bucks each, so $910. Then let's enter our purchase. And I bought another 15 units at $106 each. So do the math on that. How much did I actually write a check for? Bought another 15 mountain bikes at $106. So what am I at? Now, when I come over here, I've got 25 bikes. We have to write out what those 25 bikes are. So I know this is a little redundant, but bear with me. So I've got 10 units at 91 bucks. And 15 units at 106. So add those numbers up, and that's what I've got in inventory. And this is assuming FIFO. We're practicing FIFO, first in, first out. So if you did the math on that, I've got $2,500 sitting on my balance sheet. That's my inventory balance right now. Okay, and then the next thing that happens on the 14th is I sell 20 of them. And I'm using FIFO. So I need to sell for my COGS. I'm going to calculate my COGS and I'm going to calculate what's left here. I've picked up 10 from my beginning balance because that's as old of a product as I have. And the other 10 come from this batch. So please write out what you think COGS is and what you think is left in inventory. And you can shut off the tape and do this, and then we'll meet back up. So I think that I sold all of these and 10 of these. And I think that the other 5 units that are left are from here. Okay, let's try another purchase and another sale. So then on the 17th, I get in some more inventory. And you just log this. I bought 20 bikes at $115. Hold on, I don't know what happened to my lights. I bought 20 units at $115. Figure that out, please. And then tell me what you think I have on the balance sheet after that transaction. Shut off the tape and we'll meet back up. I've still got my 5 units left after that sale a couple days ago. And then I've got these new 20 bikes that I paid $115 each for, 2,300. So right now I have 2,830 sitting in my balance sheet. Let's do one more purchase and a sale. Oops. So on the 28th, I bring in my 10 more bikes. Cost has gone up again. Please calculate what this number is, and then what do I all have in ending inventory, and we'll do one more sale, and then we can figure out what we think our total is for the P&L and for the balance sheet. Okay, so now I've got 35 bikes, right? Same 5. I know this is a little tedious, but bear with me while we're learning. And the same 20. And now I've got this last 10. So right now, sitting in inventory, $4,020, and I'm going to go one day and I'm going to sell 23 bikes. I want you to do the cost of goods sold and of course the ending inventory. So shut it off. I'm selling 23 bikes. So you start at the bottom of the chart and just go up until you've absorbed them all. And the ending inventory is the difference. So shut your tape off, please, and let's do this. Okay, so COGS, 23 bikes. I'm going to pick up these guys because they're the oldest. First in, first out. And if I sold 23 bikes, and I just picked up 5 of them, there's 18 left from here. Now my COGS was $2,600. What's left in inventory? I only picked up 18 of these, so there's 2 of these left for $230. And there's 10, all 10 of these. And again, this is not physical flow, this is a cost assumption. So 1420. So at the end of the period, I have reported this number and this number, 4,570, according to FIFO for COGS. And my ending inventory, my balance sheet number is this. Okay. The next one we're going to practice is LIFO, and it works exactly opposite. So take another piece of paper. We're using the same data, and let's set up LIFO. Eight goods purchased, COGS goes on the P&L, and my inventory balance, which is of course the balance sheet. And go ahead and put in your beginning inventory, just like we did, 10 units at $91. Okay. The purchase is going to look exactly the same on the 3rd. So again, bear with me, just go ahead and copy that. I bought 15 units on the 3rd at $106 each. So now what do I have? I've got 25 units. Go ahead and write it out, and then we'll do our first sale. And again, always turning off the tape, doing your own work, and then coming back and checking in. Okay, now I've got 25 bikes to sell, and on the 4th, I sell 20 of them. LIFO, last in, first out. So the last products in were these 15. So I sold 15 bikes that I had purchased at 106. Okay, 20 bikes. I picked up 15 here. I'm going to go grab the last 5 from there. 5 units at 91, and that equals 455. So my COGS totals $2,045. What's still sitting in ending inventory? These old 5 units, right? Last in, first out. I sell the new stuff. The old stuff is still there. I've got 5 units at $91 still sitting there. Okay, now I make 2 more purchases. I'm going to have you record them all. I'm going to have you shut off the tape and get even with me. I buy 20 at 115, and then on the 28th, I buy another 10 at 119. Okay, so what I want you to do is go calculate ending inventory. Okay, so let's do a running inventory, and then we'll do our last sale. So shut off the tape and meet up with me. Okay, so let's see, where am I? So on the 17th, I still have these 5 guys. and I added another 20. And then I added yet another 10, so I've still got these plus the 10. And obviously you have software that does this, but we do this by hand so that you can understand why you would choose one method over the other and what the ramifications are on your financial statements. Okay, so now I've got 35 bikes. They're sitting on my balance sheet at $39.45. And I make that sale at the end where I sell 23 bikes. I want you to go figure out cost of goods sold. I've sold 23 bikes, last in, first out. So from the bottom up, turn off the tape, calculate COGS, calculate balance sheet. Okay, so I sold 23 bikes, so I sold 10 out of here. And the other 13 came from this batch. So therefore, let's see, what did I say? 13 came from here. So I have these oldest 5 units, last in, first out. And then I've got 7 still sitting from this batch. This number obviously is my 709. This number right here, 1260. Sorry. 1015, 107, 805. That makes sense. Plus 455. Okay. So, what's my cost of goods sold number? This sale plus this sale, my COGS, 4730. And my ending inventory is what's sitting there on my balance sheet right now. And I'm going to put that in on this chart so we can make a comparison. So LIFO, 4730, ending inventory, 1260. And hopefully this will be exactly what you would expect. That under FIFO, my COGS is lower, my ending inventory is higher, period of inflation. LIFO, my newest stuff went through COGS, so that number's higher, ending inventory is lower. Weighted average is going to come in just between. Okay, last one, let's set up same set of data for weighted average. I know this is time intensive, but this is really the only way to learn it. Let's purchase, COGS, and balance. Okay, and let's put in our beginning balance, which is those 15 at 106 bucks. No, what am I talking about? Sorry. Sorry, beginning balance was the 10 units at 91. Okay, so the next thing that happens on August 3rd was I buy those 15 units at 106. So now we are going to average out what we've got. So we've got 10, so this is where weighted average is a little trickier. We've got 10 units at $91. We've got this new purchase. So now you need to figure out a weighted average cost. So we've got 25 units and $2,500. So we can take 2,500 divided by 25 and see that our weighted average right now is 25 units at $100. Okay, so we have to constantly be updating that for purchases or sales. So next thing that happens, remember we sell our 20 on August 4th. Okay, so I didn't purchase anything. Here's where you're going to use this. My cost of goods sold is this weighted average I just calculated. I sold 20 bikes at $100 of cost flow each. So my COGS is $2,000. And how many units do I have left? I had 25, just sold 20. I've got 5 units left at the weighted average, the most recent weighted average. So I've got $500 sitting in my ending inventory. Okay, now let's go make a purchase. I'm going to have you turn off the tape and do this. I bought 20 units at $15. So figure that out and then figure out what I have in my ending inventory and then do your weighted average calculation. And we'll meet up in a second. Okay, so 20 times 15. I just made a $2,300 purchase. I'm still sitting here with these 5 units at $100 each. That never changes. Well, it changes every time you make a purchase, sorry. 5 units at $100 each. And then I just bought another 20 at 115. And now I do my little, and now I've got 25 units. And there's $2,800 into them. So 2,800 divided by the 25 bikes I have now, my new weighted average for these 25 units is $112 each. Okay. One more and then we'll make our sale. I buy 10 units at $119 each. Turn off the tape and now you've got to do your updated weighted average after this purchase on the 28th. And then we'll make our sale and do our comparison. And that's our wrap. Okay, so hopefully you finished this. So $11.90, right? So what do? I pull down these. These are my last 25 units. And then I just bought these. I've got $3,990 and I've got 35 bicycles. So if you do the math, it looks like my weighted average for those 35 bikes is about $114 each. So when I make this sale on the 30th, it's super easy. I just go and pick up my last weighted average. Just like I did up here, I went and picked up my last weighted average. So 23 bites at 114 each, 2,622. And what's left in my inventory, 35 minus 23, I've got 12 bites left. At my last weighted average, of course, 114. So this is my ending inventory. And my cost of goods sold were the two batches, 2,000 and 2,622. So that was my COGS. So let's take this back to my original chart. My cost of goods sold, just like I promised, right in between FIFO and LIFO. You can always check your own work. And my ending inventory, 1365. Between the two numbers, you can always check your own work. So I want to give you some, obviously, opportunity to do this on your own. So what I would like you to do for the next what I would like you to do for the next lecture is to prepare for the next lecture, I would like you to do these. Quick study 6-2. It's on page 240. And quick study 6-5, quick study 6-6, quick study 6-7, quick study 6-20, and exercise 6-4. So I want you to work those, and then you'll come and watch this lecture, and we'll go over those, and I'll do some more. I'll talk about a few more of the concepts in this chapter. And then I have another lecture in this chapter where you will get ready to do your special project for chapters 5 and 6. It's your last special project, and also where you will prep for test number 3. So I hope this has been helpful, and let me know if you have any questions. Thanks, bye.